Now I'd like to invite Leigh back to the stage. He's going to talk a bit about the genesis of this conference and the massive transition taking place on the buy side, but also going to talk a little bit more about some new thinking that's taking place around multi-factor models.
It's going to be right. So just a raise of hands, how many of you were here for our New York City conference last year? Okay, so very few of you. So this talk is going to be about half of what I gave last year. The other half is going to be something very new. It's actually the first time I'm giving this talk. You'll see at the end it's a little bit different from what you've probably seen, but it's a really unique concept that we've been hearing a lot about as we talk to certain firms and certain friends who are running other quantitative firms. But just to start it out, a little bit of my background, just to give you some context for what I'm going to talk about. I started my career basically running semi-systematic factor models, earnings surprise, earnings revisions, post-earnings drift, basic strategies that worked really well, like 06 to 11. Some of them have been arbed out since then. Some of them still work pretty well. Then went on to run product at StockTwits, and then eventually found Estimize. The reason that we started this conference was largely this quote, and I think it's really important to read it. This is from David Siegel, the founder of 2 Sigma, which is one of the best quantitative hedge funds in the world. The most effective way to address hard problems like forecasting asset prices or optimizing portfolios is, in my view, the same as for any other extraordinarily complex challenge. Use the scientific method. Doing so not only brings greater rigor and integrity to the investment process, but it also helps us combat a wide range of harmful but common cognitive and emotional biases. The availability of massive amounts of data and cutting-edge technology only magnifies the power of the scientific approach. I'm going to get into both of those last 2 concepts here, but I think it really is so important to just sit back and really have an appreciation for the fact that all of this stuff, some of which these vendors will be here today, obviously some of them who aren't, Estimize, all of this unique data is worthless without a systematic approach to using it. If you buy this stuff, and I'm going to, I obviously won't say the name of the firm, but a very large discretionary hedge fund, a former PM there walks into my office a couple weeks ago and says, yeah, I went in there and they were buying the credit card data and the web scraping data and the email receipt data. And I asked, was anybody using it? And they said, oh, no. And they were paying a ton of money for it. Nobody was using it there. And he walks in and he says, why? And they go, well, nobody really knows how. And said, well, why'd you buy it? Oh, because we thought we had to have it. He goes in, he's a quant by background. He's not supposed to be running a systematic strategy. He doesn't, but he uses all of the data to build a data-driven strategy. They give him $100 million to run a portfolio, very small for that fund. He does incredibly well for 2 years. He goes to them and says, my deal's not very good and I'm kicking ass here. Whereas the fund's not doing very well for the last couple of years. And he says, I want a bigger book and a better deal. And they go, no, this is not really what we do. And he goes, well, I mean, everybody else is, doing pretty crappy here. You have to have a process to use this stuff, or don't buy it. And I'm saying that to my own detriment here in selling you our data, which I think is pretty damn good, as is, a bunch of the other data from the other vendors here. It has to be used correctly. Put the process in place before you do this. We've seen so many funds kind of put that cart before the horse here and then retrench. And I actually think what's going on right now, and I've seen this in some of the other vendors in our industry, in losing clients. Because in the past number of years, firms have bought all sorts of data. They've maybe not known how to use it or used it poorly, and now are, in a sense, retrenching on the data side because they know they have to go back and get the process right and the people right first before they're actually able to use this stuff correctly. So with that said, what do we do at Estimize? I think a lot of you kind of know about us. You may not know exactly what it is we do and where the data can be leveraged. So in a sense, Estimize is Thomson Reuters IBIS and StarMind put together except crowdsourced from you. So we have a broad community, about 80,000 contributors at this point, of buy-side analysts, PMs, traders, as well as independent research analysts. We do have 26 of the largest sell-side firms contributing as well, including Jefferies. But more importantly, which is the interesting thing, is about half of the contributors are non-professional, corporate finance professionals, industry experts, students, academics. And one of the interesting things is that the non-professional half of the community who contributes to the data set is actually more accurate than the professional half. Now, this isn't because of some skills gap or information gap. It's because they actually more severely self-select for what they're going to estimate on than what the buy side does. Buy side analysts might have to make 30, 40 estimates a quarter, whereas the non-professionals may make 3 or 4. And they're obviously self-selecting for those names and what they're going to estimate on and who they are. This is not a random selection of people on Fifth Avenue in the middle of the day. These people come to our platform because they want our data on very specific things. Why do they contribute at all? So on a broad level, this is a public goods market. Research from Richard Thaler, late 70s, early 80s, looks at why do people participate in public goods markets. And it actually turns out that as their perception of the value of the public good or service increases, their willingness to participate actually increases, which is counterintuitive to something like finance, where you would assume a differentiated view on the EPS or revenue of a high implied vol company around an earnings report would be incredibly important to keep to yourself. Well, if we give you pseudonymity, as we do, and we don't ask you to share your true identity on the platform, you're not getting arbed in any way whatsoever. And so the assumption, which is what Thaler figured out through his research in the 80s, is that people will contribute, and they'll contribute in increasing amounts as the perception of the value increases. The other thing that this is basically a dark pool for the trading of this information. So whereas you may call around to your peers on other desks at other funds and say, hey, what are you expecting? You may call your Jefferies equity sales guy and say, hey, what are you hearing? This is basically just a more efficient process for that exact behavior. So basically what happens is you come to a page like this. This is an example of Netflix. We give you smart entry forms. You put in your estimates. We do EPS revenue for everything. And then for a list of about 200 companies at this point, we do KPIs. So for Netflix, it would be domestic subscriber growth or international subscriber growth, iPhones, which unfortunately don't exist anymore as a metric, but same for sales, all of that kind of stuff. And once you've actually put your information in for each given quarter, we actually allow you then to see all of the information from your peers for that given release completely for free. Now, we obviously own all of that data, and I'll talk about that in a second, but we give you all sorts of visualizations as well. So this is the scatter plot, EPS by revenue for a specific quarter for Salesforce. So you can see the distribution dispersion of estimates from your peers. You can see the change over time in that consensus. Now, what's interesting here is we allow people to revise as many times as they want throughout a quarter or up to 4 quarters in advance. So you have a full year of estimates there. And we see that the consensus revisions trend actually leads the Wall Street consensus revisions trend in the direction of future revisions. Well, that's obviously because if you have a system where people can go in at any point in time and update or revise their estimates, it's going to be more reflexive to new information or simply new sentiment in the market. So very important to understand where the Estimize consensus is at any given time, because it will better reflect what's actually baked into the market. Not that this is the most important thing either, but it's also far more accurate than the IBIS data or any of your Wall Street estimate data sets, about 70% of the time. It's going to be about double the size in terms of number of estimates per release. This is by cap size here, obviously large caps all the way up there. The important part is not about the fact that the large caps have so many more estimates. It's really the small and mid cap stocks. You have a sell side kind of only contribution data set that has 5 sell side estimates. That is not a very good representation of what's actually baked into the market. We have 12, 15. You're starting to get to a much better number that really actually represents what's baked in. And this can obviously be used in all sorts of different models, whether it be alpha generating factor models or whether it be risk models. We've got all sorts of literature and decks that we can send you guys, but we work, primarily with the systematic quant funds as well as the discretionary funds who do look at data in a more systematic fashion to help them build alpha and risk models around this data and integrate it into their process. So our main product is obviously our data feed. You can get all of the data in real time. We obviously have algorithms that make sure that the data is clean. People can't contribute crazy estimates. We weight the contributors in the consensus differently based on all sorts of different variables. And then we do have the front end of the platform as well that has a screener, and we can license that too. Back to what I actually want to talk about today. So there's this big shift going on from kind of religion to science. And really, the scientific approach is the quantitative method at the end of the day, rejiggered a little bit. And you've all heard about what's going on at different funds. Some of your funds are going through this as well right now and have been written up in, in the literature. But the biggest thing is that the scientific approach really starts in quantitative research with factors. This is the classic way that we do research. These are some traditional factors here. You're going to hear more about factor models if you're in track 2 later on. But traditional factors like price to earnings, price to book, those would be our traditional value factors, relative value factors, growth factors. We get stuff like the Estimize stuff, post-earnings drift models, history surprise models. We get momentum type stuff. We get pure price stuff like price reversals and earnings momentum, acceleration in sales. And then we get risk factors like volatility, and these are things that we may want to limit or expose ourselves at different times. Market liquidity, what sector the stock is in, currency risk, all sorts of stuff. And over time, starting with the academics and really, what happened with Cliff Asness at Chicago and some of his peers that created kind of the first major kind of factor-based systematic funds, we find that, these factors work. This is from the MSCI presentation from our last conference. And we can see that over time, these factors do outperform, basic indices. So we know that empirically, the concept of saying, I have a variable, whether it's price to book, revenue growth, market cap, volatility, and I'm regressing on price, that there is an advantage there. And we have a very specific set of rules for how to go about that research. And these are well codified in our industry. You don't break them. And if you break them, you come out with very bad results and you end up doing poorly in your systematic strategy later on. Now, these obviously apply to both systematic and non-systematic strategies. It is the quantitative research process. We have some of these models at Estimize as well, like an earnings yield model, where it's severely outperforms the index by basically taking our estimate forward-looking data and applying it to an earnings yield model, going long the top quintile of earning yield names on a quarterly rebalance, and you can see what happens here. Stuff like post-earnings drift models, where it significantly outperforms the IBIS data and produces a lot of residual return, like pure alpha. And through earnings models as well, like this, where we're able to understand kind of how much risk is in a stock prior to the announcement by looking at the delta between the Wall Street and the Estimize consensus. And we can see that when there is a large delta there, you actually want to go in the other direction because it's baked, basically. So a lot of what you guys spend time trying to do on the discretionary side is understand what is baked into the market at the time of an earnings release. This model does a really good job of that and then providing alpha in the 20 days post-earnings. And this is where we get into kind of the meat of what I really want to talk about, which I will preface with the fact that, it's a little scary for me. This is the first time I'm giving this talk, and it is right on the very fine line of my own understanding of this, because I think it's very right on the fine line of our industry's understanding of what's going on with some of this stuff. This part of this talk is really put together through my conversations with my peers on the systematic quant side, some long-only funds, some kind of pure alpha funds. And it is really the vanguard of what I think is going on, and it will change over the next 10 years. I think a lot of what a lot of you in this room are doing on a day-to-day basis. So please don't laugh at the artwork. So how do quants think? Basically, we think like this. We take something like price to book and we regress it on price. And assume this is all outcomes for all stocks over the course of, 5 years or whatever. There's not enough dots there, but I basically just took a pen and went like that. But roughly, you get a very tiny R squared for something like this. And this is what we're relying on like really, like this is what most quantitative research is relying on. R-squareds that are very, very, very low. We're looking for a tiny incremental advantage by sitting there saying low price to book is better than high price to book. This works. It's amazing that this works. It's amazing that we've been able to find these things. But it's also amazing that almost all of these strategies rely on something like this that has such a low correlation. And yet trillions of dollars are now being run on this kind of stuff. It's absolutely amazing. And all of this money is now sloshing into smart beta funds, which is basically what this is, based on the fact that with this tiny, tiny tilt on this one variable, we believe that we can eke out, some return. And what we do is we basically take a number of these different things, like price to book or momentum or earnings revisions or price to sales or whatever your factor is, low vol, sector, market cap. And we say, okay, we're going to take each one of these things that has very low correlation, but a slight tilt, and we're going to basically equally weight them, let's just say, in a multi-factor portfolio. And we're going to hope that at one point in time, this one does well when these two don't do well. And as we have seen over the last, well, basically 9 years, value has not worked at all. Now, historically, value works. I think I could put up a really good argument for why value will never work again. That's not what this talk is about. But the point being, if you ask Cliff, he'll say value has not worked at all, but the reason that his firm has done well up until this year is because everything else has made up for it, right? And that is the concept of a multi-factor model, is that not everything is going to work because that tilt is really, really small. And these, multi-factor models will, at certain times, different parts of them will work. And you can see, you'll eke out a gain against the index. So yay, we beat the index, now give us all of your 2 and 20 money at, 35 basis points a year. That's basically your like MSCI quality factor ETF, right? Instead of having Fidelity, run that money. But that's how quants think, because that's basically the process that we've had for ourselves forever. Like that's really the only process we've had, and mostly because the technology only allowed us to do that. That was also the way that there was efficacy to our research. We could do in and out of sample analysis. We knew that if it worked in the first half and then it worked almost as well in the second half, that it should work going forward, right? But that's not how humans think really at all. We don't think about stocks as, the marginal, stock with a lower price to book is always better, on average than the marginal stock that's higher price to book. That's not how we think at all. That's not how humans behave. That's not how we treat the market. How we behave is basically some high valuation stocks are great investments and some low valuation stocks are value traps, right? We see this all the time. And one of the things that these quant models have a hard time with is, in a sense, finding those value traps, because, they're relying on such very basic information. We believe as humans, as discretionary managers, that we can pick out those value traps, and hence we can outperform a systematic portfolio of value. That's why we still exist, right? And if you didn't believe that, you wouldn't be doing this job. There would be no point. I still truly believe that humans can do that if, as we talked about with Parag, they have a systematic strategy to behave in a certain way, to run it over and over again, and to not fall prey to some of those behavioral heuristics. But what if we did something a little bit different? What if, kind of out of thin air, we were dropped in our lap a very different set of technology that had been developed over a long period of time that completely changed the paradigm of how we look at factor models? This is where I get a little queasy with giving this presentation, because it goes into trying to present very abstract concepts in my drawing, which I'm very bad at. I don't think there's really any good way to draw these things, because they're based on very abstract, non-linear kind of quantitative concepts. But this is the best way I can do it, so hang with me. Let's say we've got 3 variables. Let's say we've got price to book, momentum, and revenue growth. the way that humans actually think about these things is that they interact. They are not separate from one another. At different points in an economic cycle, you may have different variables that investors like more than others. And at other times during the cycle, they might like them less than others. At different points during the cycle, stocks with high revenue growth and high momentum may have their multiples increase. And at certain points in the cycles, like we've just seen, high revenue growth, high momentum stocks may have their multiples decrease because some other variable is interacting on them. Some of the new nonlinear machine learning technologies are now allowing us to basically look at the interaction between these variables instead of treating them as separate. So in a sense, you're taking a whole bunch of two-dimensional regressions and you are shoving these variables into a three-dimensional chart, but it's not really 3 dimensions, it's really X dimensions. Because you don't just have 3 variables, you have, let's say, 50 different factors. And you're looking at the interaction between these factors, and at some points, among some variables, some permutation of variables, we inevitably find, or these algorithms find, and I'm being very vague about what algorithms, because the names don't matter, I'm just trying to get the concept across here, that the interaction between these variables produces the ability to invest in a specific stock because of those factors that it exhibits. This is a little bit of a better way to show it, I think. So picture you have these panes, each one of them is a two-dimensional regression, and now obviously each of these is the price to book regression that I draw, so each one of them would look a little bit different, but just hang with me here. The red dots represent literally a stock's return within that regression for that specific variable. And what these algorithms do is they actually go in and they say, okay, it looks like if you have something with a, it could be a high price to book, and it may not have performed very well, independently, but if it also has, high momentum, and it has high revenue growth, and it's in the technology sector, and it has a low market cap, that those variables interacting on one another combine to give us an advantage. And that's kind of how humans think at the end of the day, right? Like that's kind of how we perceive the market. We all have our individual biases regarding what we think, each other will interact on, and in a sense, it's a game within a game. But what these algos are doing is they're going back and seeing over time and on a changing basis too, what variables at what times for what stocks combined with each other will actually give us an advantage to generate alpha. I bring up Amazon kind of, as the premier example of this because, and I'm not saying that one of these algorithms kicked Amazon out as, having an incredible advantage, but based on the fundamentals of Amazon, who would have ever guessed? Amazon is not in any of these models, right? It may be in a revenue growth model, but the thing with a multi-factor model is, especially if you're trying to do kind of a long-short market neutral model, is the the value stuff will kick Amazon out, every time, and it will de-weight Amazon. Whereas the revenue growth stuff and the momentum stuff will obviously keep it in there, and there will be all of these cross currents in your model, which will negatively affect it. And that is, in a sense, what's really hard about the way that we do systematic quant these days, or even some of the quantamental stuff, is that if you have a list of factors, and 5 factors say, yeah, this thing is, absolute, blaring red light, and you have 5 factors that say, yeah, green light, like we see a ton of alpha in it, the model is going to have a really hard time with that. But it may just be that, like, an interaction between those factors ends up producing a really good outcome. And these models are starting to be able to tell us, when that happens. So what would be the outcome of this if this gets into the market? Well, I have to tell you, it already is. I have a friend who runs an $8 billion long-only quantitative asset management firm, and they're already using models like this and significantly outperforming their peers. Now, it's not very deep yet, It's at the very beginning. This is kind of the vanguard of what's going on. But it has some very significant implications for the concept of quantitative research. Now, one problem, which I think a lot of you would probably bring up, is, well, there is no out of sample. I brought this up, again and again. I was out in Utah at a conference recently, giving a presentation about certain things. And one of the things that we're doing at Estimize is actually using one of these models to build a kind of nonlinear select consensus. So the consensus that we have right now is based on the classic quantitative research, right? We take each individual variable. The variable might be z-score of a user's historical accuracy, the recency of their last revision, and how many estimates they've made historically. Each one of those may have a positive correlation to future z-score of their estimates. And then we weight each individually in that complete algorithm. The recency bias is overweighted relative to the other ones, but they don't interact upon one another. But the new algorithms, basically allow you to go in there and, as I said, you throw all sorts of different variables in, like sheep-wolf score and how long ago they signed up and how many seconds they spent on the page before they made the estimate. And these may interact with each other at different times for different people. I presented this, and Bill Sharp, who all of you obviously know, afterwards asked me the question, and he goes, for these nonlinear models, how do you feel about using them in stuff like what I'm talking about regarding putting together a better consensus versus building an actual stock selection model? And I looked at it and I said, I completely agree that this shouldn't be used yet in stock selection models or fully systematic, leave it alone, let it build a portfolio of models. And he basically shook his head, in agreement. And I think a lot of people in our industry would agree with that at this point. They're starting to figure out, and I will say this for certain, while I do understand some of these nonlinear models, I'm not running them, and I do not have the intellectual horsepower to run them either. People on my team do, but I do not. The people that I trust within this industry, I think we've gotten to the point, and this question comes up at every conference I go to, do we understand how to actually evaluate one of these models on an out-of-sample basis? Do we understand when it goes wrong? Do we understand whether it'll work in the future or whether we've just data mined everything, in the past? Some of the ways that they've come up literally within the last couple of years are allowing us to get comfortable with the computer doing these things. I'm still a little queasy about it, but I've seen the results from what I've been talking about here, and it works. And I think that as we go forward, if this spreads out, I think it's going to change the way a lot of people look at the analysis of putting together strategies. Again, the basic factor model, regression model, is the way that we've done it since the very beginning. And all of this money that's being put towards these ETFs and these index products is all based on this old model. And I have a feeling that if this thing kind of seeps into the market enough, it could really take all of that advantage away. Going back to something I said earlier, which I didn't want to get too far into, but I think there's a reason that value hasn't worked for 8 or 9 years. And it's because value is not a behavioral product. It is literally a product of number crunching, right? We know what variables are value. And historically, it was up to the human to basically crunch all that numbers. There's too much systematic money in the market right now crunching the numbers on value. And I would be really surprised if any human could basically, get to that faster than these models that, Cliff is running. And if he's not making money anymore in value, now he'll tell you that it's going to come back eventually, that you don't throw out 100+ years of data just because 8 or 9 years don't work. And I have the feeling that except for severe liquidity shocks, value's not coming back, because it's basically just a number crunching exercise, and we've got too many computers doing it. I also have a feeling that this stuff has seeped in now, and it is taking away some of that advantage as well. Things like momentum, which are pure behavioral outcomes, I don't think will ever go away because they are not a number crunching exercise. But stuff like value, I think may be gone, and I think this is adding to it as well. We've seen recently Marco Lopez de Prado, who was running a very large and quiet book at Guggenheim, go over to AQR, and he was killing it over there. And there are some whispers that he was using some of this stuff as well at very large scale. So I would just pay attention to the research. This is where, as I was talking about with Parag, it's important to be up on what's going on. Even if you are not going to be the one who actually puts it into place, understanding the technological and data kind of advances in our industry more than ever is going to be important, so that you're prepared to go out and find that person who really can operate on it. And back to our conversation as well, as we talk to more and more firms, and as I said, most of our business is quant systematic, but more and more it's becoming discretionary. And I'll tell a very short story from one of our other conferences in London, where the quant on the desk at a very large discretionary fund comes up to me and taps me on the shoulder outside the room and says, "Hey, I'm the quant who's looking at your data." I say, "How's it going?" And he goes, "Oh, it's great. Several different models. They look great." I go, "That's great. Are you guys going to buy it?" And he goes, "No, I don't think so." Well, why not? He goes, "Well, I can't convince my PM to actually put it in, to their process because we don't really have something like that." About 2 months later, he left the firm because he was just, super disillusioned with the fact that stuff wasn't getting in. It's so important to have that quant as part of your team and not look at them as a separate person, not look at them as a separate part of the process. Because not only will they be the person that hands you stuff like this, they will be the person who also explains to you what's going on with the vanguard of the technological developments. And they're moving really quickly now. I don't have the slide in front of me. It's actually in my deck from another conference a couple months ago. But I was out in London for the Wolf Research Conference, actually. They're presenting this afternoon. Really interesting model that they're going to present. And some academics get up there, and they basically present findings on the history of machine learning models applied only to price, basically random forest models, and long short-term memory models. Those words may not mean anything to a bunch of you, but the point is that kind of is the point, though, is that those words may not mean anything to you, but yet what they showed is that for this long short-term memory model, it generated a ton of alpha about between 10 and 20 years ago. And about 10 years ago, it went flat, and over the last 5 years, it has lost a ton of money. It is gone already. And most of you probably won't even know what that machine learning model is, but the alpha is already gone. And so one of the things that comes out of this is the conversation on, should I be running that treadmill with everybody else trying to understand what's next? It can be incredibly overwhelming. With the data, I guarantee you World Quant is going to get to and arbitrage any data set that you want to get to faster than you will. They have a literal machine that does this, and a figurative machine in terms of their process. I would not look at unique data in that fashion, as I would not look at the technology in that fashion either for the vast majority of you. I would look at the data as there are ways that data is going to be arbed by some of those funds that you will never compete with. And there are ways that you can use it in your idea generation and risk management process that will absolutely help you if you have the right process to use them. The same thing with the technology. You are not going to beat some of these other firms like Rentec to that long short-term memory model, which they were probably using 15, 20 years ago. But it's going to be very important to understand what's going on here, because it will completely change how factors interact in the market. We're talking about understanding what factors you're exposed to. And I think everybody in this room at this point either has it on their radar or has already started to put together a process for understanding what factors we're exposed to and how we want to leverage that. I don't think there's any fund out there right now that LPs would give money to that isn't doing that, because we see what happens. Firms get blown up across the board. So I think it's important to understand, are you running that treadmill race? Or do you have to understand how it will impact you, how it will impact the market, how it will impact the stocks that you're picking, how they'll behave? We've seen in the market that, things are behaving differently than they've ever really behaved because there's so much systematic money. And you get these cascades of factor selling and buying. And if you're not, aware of what's going on there, I think you're at an incredible disadvantage at this point. So I hope my, funny diagrams were able to explain well kind of the concept here. In the afternoon, there's going to be basics of machine learning. I would encourage some of you to join that. I would encourage some of you to join the basic data science class. Don't think that one is better or worse than the other. I would say, many on the discretionary side should actually go to the data science class, because it is the basics of stuff. The machine learning stuff will not help you if you don't have that first part. So please don't just pick a track because one sounds more interesting than the other. Again, thank you guys all for coming, and we'll go grab some lunch.